Mitch, Dan has said we got plenty of blame to go around, and you're facing, you have the front seat to the credit markets. The question always comes about is that why should we have this rescue plan? You know, what is important about the credit markets? Can you bring us to the common person why the problems that you face in the credit markets, and why is it important for us to stabilize the markets?
We can start. If you look at what happened with PNB Paribas, the funds that they froze were basically short-term bond funds, 12 to 18-month maturities, and they purchased asset-backed securities. And they were AAA rated, but the market dried up for them. Investors were trying to pull money out, and they couldn't. There was literally no market. So this was the first hint that we had that markets could dry up and go away for AAA rated securities. So what BNP had to do was actually freeze withdrawals on those funds until they could get liquidity sufficient to meet the investor demands. So clearly, from a credit market perspective, this is something we've been dealing with for a long time. Where the issue in terms of the most recent market turmoil really came to a head about 2 weeks ago on Tuesday. I was down in Cincinnati. We run about $9 billion in money market funds in the Fifth Third asset management complex. And the one thing that everyone understands in terms of investing, the prices of stocks go up, the prices of stocks go down. You've got volatility there. So I got a stock fund. I expect that I could have that day when it goes down, and I might not like it, but it can happen. If I've got a bond fund, the price of my bond funds yesterday actually went up pretty dramatically as treasuries rallied and interest rates fell. But the one thing that all investors believe, okay, and they believe it with their heart and their soul, is the fact that if I put $1 into what's called a 2A7 registered money market fund, which is registered by the SEC, I put that $1 in and I need that money back out tomorrow or the day after, a week later, I'm going to get my $1 back plus a little bit more, guaranteed. I might not get a whole lot more back than my $1, but I'll never get less back. Well, on that Tuesday, that fateful Tuesday, I was with our money market group closing it down, headed for a little morale boosting at the local pub. And just as the computers were going down at about 5:45, the head of our money market complex, John Hoding, said, "Oh my God, I think we broke the buck on the reserve funds." And what's important here is the reserve funds were the first money market fund complex. Bruce Bent, you might have saw him on CNBC quite often, would always talk about how important it was to be safe and boring your money market fund complex. And he started them back about 40 years ago. So it flashed across the screen that they'd broken the buck. Okay, instead of getting your $1 back, you're only going to get 97 cents back, and this was from the first and the oldest money market fund complex. The premier fund, about a $68 billion money market fund, was only going to pay off 97 cents on the dollar because of an almost $800 million investment in Lehman that went from 100 cents on the dollar on Friday down to 0 on Monday morning. And when we saw that happen, it became readily apparent to us that the markets were going to be in for a very, very tough go on Wednesday. And what you see here is what's called the classic flight to quality. And this is when investors lose confidence in something as basic as a money market fund, okay, because of what happened really on Tuesday evening with the reserve funds. Investors fled to the safety of Treasury bills. Now, we've got about a $2 billion Treasury money market fund, and you know, we would, if I was ever asked what could be the biggest problem that you could have in your fund complex, it would never be with my Treasury bills, because they are, and all the professors here will say, it is the largest, it is the deepest, it's the most liquid market out there. You can always buy, you can always sell Treasury bills. Except when there's so much demand, no Treasury bills are available. And what happened on Wednesday into Thursday, you saw the yield on Treasury bills plummet precipitously. They went from a little over 1.5% before this crisis to all of a sudden there was so much demand pouring into the funds, Treasury funds, that the yield declined down to 13 basis points. We actually had a case on Thursday where $1.5 billion of Treasury bills traded at a negative yield. Yeah. Okay. a negative yield. You will never get more than par back in a treasury bill. You buy them at 95 cents on the dollar and they pay off at par. You buy them at 97 cents on the dollar, they pay off at par. You buy them at 101 cents on the dollar, they pay off at par. So if you want to talk about fear and loathing in the capital markets, when you see this decline, then we go on to the next graph here where actually during the day, don't look at just where the average treasury bill yield was. Look at where we actually had negative yields impacting in the market